I know these are overnight developments, and you haven't had a chance to think too much about them, but it's a time this morning of rising global uncertainty, higher oil prices. Tell me how you process all that.
Well, I think it's very early. I mean, obviously, events just happened last night, and so I haven't had a chance to look at the market data. I guess oil prices are up. There must be more uncertainty, and I think we're just going to have to, see how this works its way out. I mean, at the moment, I think the fundamentals for the U.S. economy are good. The labor market is strong, so I think we're in a pretty good position there.
And this becomes a matter of how long the uncertainty continues, how long oil prices remain high, depending upon the economic effect they'll have.
That's right.
Let's talk about the outlook for 2020. These are early days of the year. 2% has been the number that you've been talking about. Is it still the number that you're expecting?
What are we talking, GDP or inflation?
Well, you tell me.
See, I mean, both are sort of relevant there. Like I say, I think the economic fundamentals are good. Labor market is strong. Unemployment's at 3.5%. Trend growth, I think, is 1.75%. I'm looking for 2 to 2.25% growth in 2020. So I think, again, above trend growth. Maybe we'll get luckier. Maybe the uncertainties will hurt us a little bit there, too. But so I think growth is good. I'm expecting labor markets to stay strong, the consumer. So I think it's an environment where inflation ought to be rising up to 2%. I think with the unemployment rate at 3.5%, very long and successful recovery, we really ought to be getting inflation above 2% to show that it's a symmetric objective. And if it goes up to 2.25, 2.5, that would be all right with me.
Back in November, you talked about being more aggressive in terms of hitting that inflation target. Do you still believe that?
Well, I think that we've been underrunning our 2% objective for a long time, and we've said for quite some time that we've got a 2% objective. It's symmetric, and I think after a while, people have to start wondering, are you going to hit the 2% objective? Now, there are a number of reasons why, headwinds have been in the way, but golly, the unemployment rate has gone down to 3.5%. The economy's doing well. The way that we would normally think about what should lead to inflation, we should have seen inflation. So there must be so much more at work that maybe we need more accommodative monetary policy. I think our current setting is accommodative. I think the FOMC has positioned us well for 2020. We've got some risk management positioning in the current setting, and I think it's one where inflation can go up above 2%. That's without, any oil price uncertainties, which obviously put another story into play.
Let's say we get to June and you're still not there yet. Would you be considering additional accommodation?
I think that's a fair question. I think I'd need to see exactly how the data are playing out. I think staying at where we are is a very good thing. I think a lot of people might kind of wonder, can you really stay at 1.5 to 1.75% if the unemployment rate stays where we are? But without inflationary pressures, I think that this is a very good setting.
Charlie, this is a fascinating time where essentially you guys are feeling your way to knowing what the unemployment, how low unemployment can go. Are you willing to just let it ride down if keeping policy where it is 3% or below 3% unemployment rate something that you'd be willing to test?
I think that's a great question. I think the way you pose it, feeling our way down, I think that we certainly have seen the unemployment rate fall from very high levels. And as we've gotten to certain points along the way, many of us have kind of gone, oh, geez, we must be pretty close to the natural rate. And then we keep going lower. Oh, it actually must be lower. Oh, there's no inflation. We kept expecting we would see inflation. 6% at one point might have been, are we going to improve upon that? Narayana Kocherlakota said we ought to be targeting 5.5. That was how long ago? And we're still, below this. And so I think that we need to be keeping our eyes on inflation, defending, promoting the symmetric 2% inflation objective, showing that we can get there. And I think the unemployment rate, it's a wonderful thing. I think more people are engaged in the workforce, gaining skills, improving their relationship with the labor market, people who previously didn't have those opportunities as much. And so I think structurally it's a good thing, too. But we really need to keep our eye on inflation. And unless inflation starts going up to something that is inconsistent with our 2% symmetric inflation objective, I think we're pretty good, well set for
Charlie,
policy.
Is it riskless to run this experiment? Are there concerns that you have that, hey, we can just keep interest rates low, we can see how low unemployment goes, and if it gets too low, we can reverse course? Is it a riskless experiment?
Well, there are always risks. That's the easy answer to a question like that. There's risks on both sides. I don't see us running an experiment where we're trying to get the unemployment rate lower. I think in the moment, I think the setting of monetary policy with the things that we're facing, 3.5% unemployment is likely to continue. It might go up a little bit, it might go down a little bit, but I think it's much more likely to be stable given the growth rates of GDP that we're, kind of expecting. So I don't see a big risk there. Now, you do hear many comments about financial instability risks, and with lower for longer rates, does that add a little effervescence in places where we don't need it? We're monitoring that very carefully. I think that the Board of Governors in Washington has been reevaluating the stance of supervisory regulatory policies and making judgments that, we can be in a position. We've got good capital, more and better capital, and, let's let the economy continue to expand.
Charlie, I got two more areas I want to get to real quickly. First of all, the ISM number came out again, showing contraction in the manufacturing sector. Your district, heavy in manufacturing. Right. What are you hearing and seeing there?
Well, I think we've seen a lot of uncertainty associated with tariff policies, not knowing exactly where supply chains can be positioned, whether or not they have to be moved. I think that the agricultural setting, not being able to export as many soybeans and pork as they would like. So I think the manufacturing sector has definitely been hit. I mean, the agriculture affects heavy equipment manufacturers. Farmers don't need to buy the combines and all of that.
I mean, so I think both factors in your district.
Right, exactly. So I think, we've definitely seen those factors play out. I think what we're kind of finding is that the economy can continue to expand with a modest contraction in the manufacturing sector at the moment. The consumer is playing a strong role. Business investment has not been strong at all, but the consumer's been strong enough. As long as that stays in place, I think we can continue to see growth, 2.25%. But of course, we can't withstand everything.
Right.
But I think we're well positioned.
Charlie, one more thing, talking about being well positioned. Everybody was worried about the overnight lending market over the first of the year.
Right.
It seemed like that rate was well controlled.
Right.
Does the Federal Reserve have to have, or should it have, what they call a standing repo facility? You've been doing temporary stuff.
Okay.
Should it become a standing repo facility so that it's there for good?
I see. We could talk for quite some time about
let's
that.
Not,
I think,
let's
exactly.
keep it short.
So I think a standing facility is something that many central banks have, the ECB and others, and so it's something that the Fed has contemplated. We could decide to make a judgment to put a standing facility in place. I think there are a number of parameters as to, what's the interest rate that it's offered at and take up and things like that. That would be important. Another alternative would just be to have a larger balance sheet so that you've always got enough reserves in the system. I think at the moment we've sort of tried to reposition our reserves so that they're more ample back to the September of last year levels. There are some Treasury events, tax events coming up in the spring, and we want to make sure that we have the right amount of reserves in place. But if you go after a more efficient level of reserves that's somewhat lower than we've been experiencing for sure, and you might imagine having a standing repo facility could help out in those moments where all of a sudden dealer brokers need access to those kinds of funds.